Welcome, everyone, to the next episode of the Spin Life Well Show. We're glad that you've chosen to join us today. You can watch us on many channels. I am Certified Kingdom Mark Trice, and in the studio with me is the ever-talented Jesse Hamilton.
Hey, everybody. Welcome to the show.
Jesse, there's so much wisdom in the Bible regarding debt. It's mainly warnings, right?
Yeah, there's a lot of warnings. There's nowhere that tells us that it's a sin, but that there's so many verses about it tells me that God knew that we might struggle with debt some.
Oh, yeah.
So it's all over Proverbs. Lots of Jesus's parables are about money and possessions. Not many of them relating as much to debt, but you can find those themes all across Proverbs.
And they're mainly warnings.
Yes.
Warnings, not a prohibition or saying that debt is a sin.
Yeah.
But can debt get in the way of our spiritual walk?
Yes.
Absolutely. So we wanted to try to apply some of this today, just really trying to help the modern believer understand things that affect debt.
Yes.
And that's your credit score.
Yeah, it has a huge impact on your ability to borrow, the amount you can borrow, and the cost of that borrowing. So,
Even your insurance cost and
Yeah,
things.
yeah,
If you
your-
have a low FICO score, we'll talk about what FICO means in a minute.
so let's just say you do need to use debt if you're maybe buying a home or you've made the decision to purchase a car using a loan or something along those lines. You need to know how to get your credit score up, because getting a higher credit score means you get better terms and less cost on the interest.
Now, Dave Ramsey always calls the credit score the I love debt score.
Yeah, the stupid score, the I love debt score.
Yeah,
And
yeah.
he says, my credit score is so low, but I could show up and buy any house I wanted for cash.
Of course you can, Dave. You think he drives a Bentley or something like that?
No, I actually pulled up next to the barbecue joint in high school next to him, and he was in a Maserati.
Oh, Maserati. Okay. Yeah, you don't want to finance that.
But the license plate said no debt.
No debt. That's awesome. So let's talk about this. Let's give some demystifying some of the issues around credit scores. A lot of people don't understand.
Yeah, and you can work on them and improve them. There are lots of services out there that will help you. They cost money, but they'll help you improve that. But your credit score doesn't define your worth or even your net worth on paper, but it can be a big factor when we're talking about the use of financing and using financial products
Okay.
to buy something.
So let's first talk about what the credit score is, or your FICO.
Yes.
Fair Isaac Credit Organization.
So I just took my test on this for the CFP training on how to raise people's credit scores, but here's kind of the outline of what matters most to least. So first is payment history.
5 factors, right?
Yeah,
five
five
factors. First,
35% of your score depends on your payment history. And all this means is pay your bills on time.
late payments can really hurt you, folks.
They can
And
linger
so
for
even if you're a
years.
day late,
Mhm.
that a ding on your credit report that you're late. Now, if you've never pulled your credit report, you should. We recommend going to annualcreditreport.com. You can get the free version there. It doesn't cost you anything, but at least you can see what credit accounts you have open.
Mhm.
It'll give you some payment history, and they have on there you're on time most of the time, 30 days late, 90 days late, and so on. You don't want a lot of dings on there for being late, because that does hurt your credit score.
Yeah, that's the number one thing, is pay your bills on time. Second up is credit utilization. So
A lot of people don't realize this.
no, you have a certain amount of credit, and keeping that below 30% is going to improve your score.
So the
So-
utilization of that. So like if I have a $10,000 in credit
On your
limits,
credit card,
credit cards, if I have more than $3,000 on a regular basis on there, that's above 30% of my total
Mhm.
credit availability.
right?
That can hurt us. So a credit card company, it used to be 50%, but that's changed, and now it's more of 30%. So you want to improve your credit score, make sure that your total credit usage, and I always do it by the account, not just my overall credit
Mm-hmm.
source or resource that I have available. Is just by the account. Make sure those credit card balances If not paid off every month, which we highly recommend,
Yes.
make sure they're below 30%. Otherwise, that will negatively impact your credit score.
But for those of you that do pay off your credit card every month, no problem. It's okay if that goes above 30%.
Right.
But this is revolving credit
Yeah.
utilization.
When we're looking at that over time.
Yeah. So next, so that's the first two, 35% and then 30% for utilization. Next up is credit history. That's 15%. So how long have you had credit on these different pieces?
So this is kind of important. I'm able to get credit easier than Jesse is, just because I'm more handsome. No, just kidding. No, just kidding. It's because I've been
'Cause you're
around for a
old.
long time. Okay, you said it, and then that will come up in your review later on. No, I've been around a lot longer. If you're an 18-year-old and you're hoping to get a car loan, guess what? You're not going to have a great credit score right now because you've never borrowed any money.
Yeah,
So expect that.
I remember some friends telling me about getting their first loan on their own. They were so proud, and I think he was paying 17% interest on his car.
I know.
But all you have to do is get these credit building products early. So as a teenager, as an 18-year-old in college, whatever, put $100 on a credit card and pay it off. Or get one of these debit accounts that actually count towards your credit.
Yes. Talk to your bank or your credit union. That's probably the better way because
Yes.
that is secured by money that you got in the bank.
Mm-hmm.
It's a debit card, so you can only spend what you've gotten there. And that particular debit card, if it's linked to your credit report, will help you build that history because you are paying it off every month with the cash that you already have. It's a great way to build a credit score without having to actually take on debt.
Right.
It's so easy to get debt when you're young because there's all these little things. It usually happens this way, Jesse, right? You've experienced this. There's a really cute girl or guy that's sitting out in front of the college bookstore and they're wearing a t-shirt that says Discover or Visa or something like that. And they tell you about all these different great things you can have if you'll just sign up. And usually you're like, well, can I date this person? What else? Oh, I get a free t-shirt. Awesome. College students love free t-shirts or a coupon for pizza. So it's so easy to fall into the trap. Talk to your local credit union or bank about ways that you can build your credit without having to actually take on debt.
Yes. And then the final two pieces here are both 10%, Mark. The first is new credit.
Yes.
So opening up too many new accounts at once can lower your score.
Oh, you would not believe the number of people that are trying to qualify for a mortgage, and at the same time, they go and open up different debt accounts to
credit card or
credit
whatever.
cards for new furniture and all these different things. And sometimes what happens is they're not approved for the mortgage.
Yeah.
What's more important, folks, the mortgage or the stuff that you put in it? Just wait. Don't, if you're looking to make a major purchase where you have to use credit, make sure you're not opening up too many accounts at once. It can hurt you.
Yeah, and your mortgage broker will help you make those choices. And then lastly, the credit mix. Having variety can boost your score. If you have a mortgage and a credit card or a mortgage and an auto loan that you're paying every month on time, that's all going to be a great boost to your score.
That's right.
So go ahead.
Go ahead and give us an example, Jesse. I think there's some good insight here.
Missing a $50 phone bill could significantly drop your credit score by as much as 50 points. That would be a dramatic one, but it could. And then keeping a $500 balance low can help you save stress. And then if you ever make a late payment on a debt instrument, that can linger for many years.
Up to 7 years. Bankruptcies are even worse. All right, let's move ahead, Jesse, because we need to cover some other things in our time allotted today.
Yeah, as I said, this score can impact your ability to borrow. So if you're getting a mortgage at 4% versus 7%, we're talking about $50,000 in savings over the length of the mortgage. And unfortunately, where mortgages are now, we're talking about 7 if you're great credit and 10 plus if you're bad credit. And that could be several $100,000 of a difference.
I remember the first home that I ever tried to buy with my wife, and our credit score was okay, but the interest rate at the time was something like 12%.
Wow.
Crazy interest. But having a bad credit score cost you money.
Mm-hmm.
All right.
So it's really important to build this and protect this score. Pay every bill on time, of course, and try to keep balances that are revolving low. And like Mark said, start with one of those secured cards when you're young and make a small deposit into it and raise your credit score without taking any risk.
So the Bible doesn't prohibit debt, but it warns us many times about how to use it prudently. Because in Proverbs it says the borrower is slave to the lender. That's a pretty strong word.
Yeah.
But we have to remember that God's given us lots of warnings about the use of debt and how we use it. It can be a good tool, but have to make sure that you are managing that. It's all part of stewardship.
Yes, it is. Being a good steward of your money means using credit wisely. Using credit wisely means improving your credit score as best as possible if you're going to use it. I got a quick anecdote I just thought of. When I was buying my house, the mortgage broker did a deep dive on my credit to try to get it up above a certain benchmark or a certain milestone. And they found something, and it was the fact that I was a registered user on my mom's credit card. And so for many years, I had my own credit card under her name with my name on the card. And turns out that she had just made a bunch of really large purchases on the card.
Busted.
She had a big event coming up, and she had spent
Oh,
over $10,000
okay, all right.
on the credit card. And of course, she's going to pay it all off,
Sure.
right off.
Right.
But on my credit score, it was saying that I have $10,000 in credit card debt.
Uh-oh.
And at the time, I didn't have $10,000 to pay the credit card debt. So I was in a negative. I could not have possibly paid that back, and that was lowering my score.
So be careful, folks. This is a good example and a good reason to pull that annualcreditreport.com. They are free. You can get one for every agency and so forth. So Jesse, this has really been a good topic. If you've got additional questions for us, let us know. Please, subscribe to our YouTube channel or follow us on the places that you listen to your podcast, and you'll get updates from us from time to time. But we'd really love to hear from you, and we oftentimes do programs where we do a whole program based on the question you asked us.
Yeah, that's right.
Jesse, how do they do that?
Shoot us a text at 254-282-0495 or an email at info@clearvistafinancial.com.
All right, great. Thanks, everyone, for listening to the Spend Life Well Show. We hope you have a wonderful week. We'll be back here soon.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Clear Vista Financial are not affiliated. Discussions in the show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.